Hi friends. Now in this session we will discuss the arbitrage strategies. Two strategies relating to the futures arbitrage. First is the cash and carry arbitrage and second is the reverse cash and carry arbitrage. In your notes, this particular portion is discussed in 10.4, which is our combined chapter for forward future pricing of normal like the stocks and also the commodities, right? So here we will see or discuss what are these strategies, cash and carry strategy and reverse cash and carry strategies, and also how to remember the cash and carry and reverse cash and carry positions. So most important part here is after understanding the cash and carry and reverse cash and carry strategies, how to remember the positions we take in the cash and carry and reverse cash and carry. So for this, these are notes for your reference. These are Falcon's notes, and we will use direct blank paper. So here we will see the cash and carry and reverse cash and carry arbitrage. So first understand what is arbitrage. Arbitrage simply exploits the pricing difference as we know it, right? So the pricing difference, if there are two assets and if there is a situation where there is a pricing difference, then we call this as the arbitrage opportunity and we exploit it by utilizing or taking some positions and utilizing the arbitrage opportunity, right? Once you utilize the arbitrage opportunity, you gain the fixed amount. Remember, in arbitrage opportunity, your gain is fixed, and here generally the cash flow is zero. There is zero cash flow in arbitrage opportunity. This is a very important point. To explain the arbitrage opportunity, I generally prefer taking or using the very layman's example, which we will use here. Imagine there is a town 1 and there is town 2. Town 2. Now, in town 1, currently, rice is selling for, say, $100 per, say, like metric ton. Okay. So this is like maybe very cheap price. For us, like it is fine, right? So here, now the price for rice in town 1 is 100 metric ton per metric ton, right? Obviously. Now there is a town 2 where rice is selling at say $80 per metric ton. Now here there is a pricing difference. Now this pricing difference can be exploited if you buy rice from here and sell rice in town 1. So buy rice at $80 from town 2 and then sell it in town 1. And in town 1 the price is $100. So you will be buying at 80 and selling at 100, buying at 80 and selling at 100. You will repeat this frequently. Now here, because these are two different towns, there is a possibility of logistical cost, that is transportation, the freight which you need to like, because you need to transport rice, right? So if you transport it, and let's assume that the price is or freight is $10 per metric ton. So here what will happen? You will buy rice at $80, then you will incur transportation cost of $10. This means the landed cost at this particular point in town 1 is $90. Still you have this arbitrage opportunity because you are able to bring rice in town 1 at $90 and you are able to sell it at $100. So you are gaining $10. Once you know this opportunity, you will be repeating this frequently. You will increase the frequency, and because you are increasing the frequency, what happens? The supply in town 1 for rice will increase, and we know if the supply is more than the demand, then price will drop. Similarly, because you are buying frequently in town 2, then automatically demand for rice in town 2 will increase. If the demand for this rice increases in town 2, automatically the price of rice in town 2 will increase. So price of rice in town 2 will increase. Let's assume because of your arbitrage exploitation, price increases to 85, and here we incur transportation cost, and your landed cost is $95. And because you are increasing supply in town 1, the price here will drop to $95 per metric ton. And as soon as these prices are equal, $95 and $95 landed cost in town 1 and $95 trading actually in town one. Okay, so when both the prices are equal, you lose, or this arbitrage opportunity is completely exploited. There is no more arbitrage opportunity in this situation. Now same thing happens in stock market, same thing happens in futures market. And here, because the markets are very liquid, very active, these arbitrage opportunities last for very few seconds. Okay, and you have to look, if you want to exploit the arbitrage opportunity, you have to look for the arbitrage opportunities. There was some instance, if I'm not wrong, someone exploited arbitrage opportunity in Bitcoin, Japanese yen, and dollar. So search for that and you will understand. So that person, again, I'm roughly giving you the idea. That person was buying Bitcoin using dollars and selling it in the Japanese yen, and because there was a pricing difference, he was able to exploit the arbitrage opportunity. Now here we use this simple example, and now let's see what happens in case of futures. Now in futures case, we know we can calculate theoretical price of futures. We will call this as FT. And FT is calculated using very simple formula. Here we will assume the basic formula, which is S0 into e to the power RT. Very simple formula, right? So if the spot is trading at 100, assuming like spot is trading at 100, and say the interest rate is currently 0.10, that is 10%, and this is for 1 year. So spot is trading at spot, whatever is the commodity, whatever is the underlying in futures, the underlying is trading at 100, the interest rate is 10%, and maturity is 1 year. If you solve this, you will get approximately 110 point something. Here, for simplicity, for sake of simplification, I will simply assume, remember this, I am assuming the futures price is, the theoretical futures price is 110. I know there will be some difference, approximately this is 110, and this is your theoretical future price. Remember, this is your theoretical future price and not the actual future price. This is theoretical, that is based on your calculation, on your paper, based on your expectation. In market, there is possibility the market futures price for the same underlying, for the same maturity, we will assume as FM. Okay, let's say FM is the actual market price of the underlying in futures market. Now, in market, the same futures is trading at, there are two possibilities, maybe at 120 or maybe at 100. Let's assume the 120 or 100. Now, if it is trading at 120, think from this perspective. You think, or as per your calculation, this futures price should be 110, but actually in market it is 120. As per your analysis, it should be 110, but in market it is trading at 120. So it is expensive in the market. If something is expensive in the market, you sell it. Simple. You sell it. If it is trading at, say, FM is trading at 100, that is the actual market price of this future is 100, then as per your calculation, you think the price should be 110, but in market is trading at 100. As per your calculations, 110, in market is 100. So you should be buying it, right? So you buy it. So you buy futures in this case. So if in the market it is trading at 100, you buy it. If it is trading at 120, you sell it. The logic is very simple. As per your calculation, if it is expensive, sell expensive. And if it is cheap, buy cheap. Buy cheap, sell expensive is the rule. This rule we will use here. Now here, these are two situations, right? So in actual market, it can be either 120, that is expensive, or cheaper, or maybe equal. So the theoretical price of this future and the market price of the future is, say, equal. So then there is no arbitrage opportunity. Then we don't need to discuss anything related to the arbitrage for that specific situation. So here only two situations are left. One, it is higher. Second, it is cheaper. Okay, so expensive and cheap. Now, if the situation is this, that is your theoretical price of future is less than the actual price. Theoretical price is less than the actual price. We call it as cash and carry arbitrage. Cash and carry arbitrage. Why the name cash and carry arbitrage? I will explain it later once I explain the strategies used in this. But here, for now, just remember, if the theoretical price is less than the actual price, the market price, let's say this is FA actual or FM market price. So then we call this as a cash and carry arbitrage. And if the reverse is true, that is FT is greater than FA, the theoretical price is greater than the actual price, then we call this as a reverse cash and carry arbitrage. Remember this. Now, what is the strategy here? How to exploit this opportunity? It is fine. Like, okay, I simply said you sell it in the future, you buy it in the future, or you buy future, you sell future. And saying it simply does not tells us what is the actual strategy, how to exploit this strategy. Now, but for now, we know, like, if the actual, that is here 120 actual, theoretical based on our calculation, and what are our assumptions? Remember, S0 is 100, T time to maturity is 1 year, and then we'll need risk-free rate, RF is 10%. Now in arbitrage opportunity, remember there is assumption that you are able to borrow and invest at same rate, okay, same risk-free rate. Otherwise this strategy won't work on theoretical level. Okay, in practical life you will apply different calculations, but on theoretical level we will assume that you are able to borrow and invest at RF only. Now here in this cash and carry arbitrage, because the actual price is 120 and theoretical price is 100, that is, it is trading expensive, so you sell expensive, so we will sell futures. Okay, so this is our position and this is cash flow, position and cash flow, and this is our time T0. This is what we are doing today when we did the calculation of theoretical price. So we sold future, and what is cash flow here? 0. Remember, in trading futures there is no initial cash flow apart from like ignore margins and all for now. So here we are assuming there is no margin requirement and nothing like that, so it is margin free market. So we are selling in futures. So actually to sell futures, there is no cash flow in that specific transaction. It is just a position. Now you are selling future. This means that at time T1, you will sell the commodity. In reality, you have to sell asset to fulfill your futures requirement, right? So we will call this as settle futures. What is cash flow and all, we will discuss it later. For now, what we will do, we will settle futures. This is your time T1, 1 year maturity. Now when you settle future, remember, you will, because you are selling in future, that is, you will sell underlying in futures. You will need underlying at this particular point. So at T1, you should have underlying. So for this reason, what we will do, we will buy S0 at this point only. So we will buy S0 at T0. We will carry it till T1. So on T0, at T0, we will buy S0, and at T1 or till T1, we will carry S0. And that's why the name of the strategy is cash and carry, because you are carrying underlying asset. So we call this strategy as cash and carry. But remember, in the beginning, I told you for the arbitrage opportunity or to exploit the arbitrage opportunity on this theoretical level, specifically in the futures, you should not have any cash inflow or outflow. But if we buy this underlying at this point, because underlying is trading at 100, so if we buy this underlying, we will have this cash outflow, obviously, because you are actually buying it. So there will be cash flow. To avoid this situation that you don't want cash outflow, what you will do? You will borrow. Borrow S0 amount, whatever is the amount required for the S0. Okay. So you borrow 100, you buy security or buy underlying S0 at 100. Okay. So you borrowed plus 100, you purchased underlying at 100. So plus 100 minus 100, your complete transaction or complete cash flow, the total of cash flow is 0 here. You will carry your asset till T1. And here, remember, you have to settle this contract. To settle this contract, what we will do? We will sell underlying. If you sell underlying, and at what rate? Remember, we entered the futures at 120. So we will be able to sell this underlying at 120. So we will get the cash flow of 120. Very simple. Because we entered it at 120. Because this was the actual price. And we will settle it at 120. Simple. Settle futures at 120. Sell S0. Now see what happens. Once you have this, like plus 120, that is you have $120 after settling your contract. So here you will sell and you will get the cash. This is actual sell. And how will you sell? Because you carried this underlying. Now this underlying is gone, right? You sold it. Remember, we borrowed some funds. So repay borrowing at T1. So we will repay our borrowing at T1. But what is a repayment amount? So we borrowed 100 at 10%. We borrowed 100 at 10%. So this amount is 110. Now we are repaying this amount 110. We settled contract at 120. We got the cash flow of 120 plus 120. And we are repaying our borrowing by like minus 110. So here we have confirmed cash flow of plus 10. So this is the arbitrage opportunity where you can exploit the arbitrage opportunity. If you are able to exploit it, you will have the confirmed gain, sure shot gain. Now there are two possibilities. First, if you get the question like what will be the cash flow at time T1, then you have to say like plus 10. And if you are asked like what will be your gain at time T0, remember, at time T0, what is your gain? You don't say 0. Okay, this is your cash flow. This is your cash flow plus gain, right? This is cash flow as well as gain. At time T0, your gain is simply the present value. This 10 will be discounted by 10% for 1 year. And whatever is the answer, it will be approximately 90 point something. So this will be your gain at time T0. So gain at time T1 is 10. Gain at time T0 is 10 discounted, present value of 10, simple. And this is your cash and carry arbitrage. Now in cash and carry arbitrage, as I said, like the problem is remembering these steps, like what positions we need to take, the sell futures, buy and then borrow. Or we can say like the sell futures, borrow and then buy, logical sequence. For this, I generally provide some like shortcut. Just remember the BBS, okay? Buy, borrow, sell. Buy, borrow, sell. So buy, borrow. As soon as you see like, okay, there is a borrow. So we are borrowing funds. We borrow funds to pay for the asset. So this means we are borrowing funds to buy underlying and remaining sell is to sell futures. As simple as that. This is BBS and simply clear the transaction here at time T1 by applying your logic. That is obviously if you have the sell futures position, you will settle. If you have borrowing position, you have to repay the borrowing and so on. So there is a possibility in exam you may get question which will ask you what will be the position or what positions you will take at time 0 if you take the cash and carry arbitrage, or what will be your positions at time T1 if you enter into say cash and carry arbitrage. So this is how you remember it, right? Now next is the reverse cash and carry arbitrage. Now here the situation is reversed. So the reverse situation is that your theoretical price is 110, but actual price is 100. So it is trading cheap. If it's trading cheap, then obviously you will buy futures. And at what price? 100. Your cash flow is 0. Remember, there is no cash flow. Now, here, remember one thing. We will get, if you buy in futures, so at time T1, you will settle your futures, okay? And if you settle your futures, that is you buy underlying and you entered futures at 100. So you have to buy it at 100. You have to buy it at 100. So you will have cash outflow of 100 like this. But remember, if you enter into futures, our position, like our clear guideline is like you should not have any cash you should have like net zero cash inflow or outflow, right? And with this, you should not have the asset remaining with you. If you settle futures and if you buy asset here at this particular point, because you entered into buy futures, you will have asset. So we need to figure out some way to clear our position at time t1. That is, we need some position which will clear our asset position which we bought here. So for this, what we will do, we will short sell S0 at what rate? At 100. Okay. So if you short sell, you will get 100. Remember this, you will get 100. And obviously we can't keep cash like this, right? So we need to invest it. So we will invest at 10%. If you invest, obviously you short sold, you got 100, you invested it. So now net cash flow is 0. Here at time t1, what we will do, because we have this short sell position, remember this, we have this short sell position. So we need to settle this short sell position. Obviously, if you are entering into short sell, you need to return asset to the person from whom you borrowed asset for the short sell purpose. So here, what we will do, this asset, this underlying, we will return it to the party from where we borrowed asset for the short sell. Then here, return asset. Here, cash flow will be 0. Remember, we are simply returning asset which we borrowed. So cash flow is 0 here. And then remember, we have this investment. So we will withdraw investment. How much we will get in the withdrawal? We invested at 10%, right? So 100 invested at 10%. This means you will get 110. So here again, the cash flow is plus 10, like this. Very simple and straightforward, right? Now, see this. The logical sequence here, if you think about the logical sequence, it is ideally the buy futures, then you short sell, and then you invest. At time t1, the logical sequence will be, first you will withdraw funds at like 100 invested at 10%. Out of those funds which you like withdrawn, you will settle your futures by buying asset. For buying asset, you have to pay 100. So you withdraw 110, your invested amount plus the return on that investment amount. And then you will settle your futures by paying 100. Then you will return this asset where you will have no cash flow and you will have $10 in your pocket, right? So this is how these cash and carry and reverse cash and carry arbitrage works. Here, if you want to remember, so the notation is like BIS, okay, which is buy, invest and short sell, like this. So you can remember like this. You can also remember like a BSI, whatever is your preference, but remember it like this. So generally, like from my perspective, I don't prefer these methods, but students like these methods. So for this reason, I tell these like shortcuts to remember it. Like in cash and carry, it is BBS, and in reverse cash and carry, it is BIS. But if you want to remember it without any confusion, always remember in cash and carry, you will carry asset till T1 and which you purchased at T0. Because you purchased it at T0, you have to remember it like this. You purchased it at T0. That's why you will buy at T0 for cash and carry. So buy S0, obviously for this you will borrow, and you have asset, you must clear your asset at time T1. So for this you need to sell in future. So here this sell future, buy and borrow is your cash and carry. This is how you can remember. This is the second method. So these are the two methods to remember. Remember for one, automatically you'll be able to remember for other. Because here, every position, if you just think about this, every position is just reversed in cash and carry. That's why we call this a reverse cash and carry. So here, instead of sell, you are buying futures. Instead of buying asset, you are short selling asset. Instead of borrowing, you are investing, right? So this is how it works. So that's why we call this a reverse cash and carry, because all the positions are reversed here, right? So that's all for cash and carry arbitrage and reverse cash and carry arbitrage. So thank you, and thank you for listening to this video. See you in the next video. Bye bye. Take care.